Imagine a world where investing wasn't for you, where building wealth was a luxury reserved to the elite. A system built to protect the few at the top, while the rest were left behind. This was a reality, a system that thrived on complexity, high fees, and exclusivity. Investing wasn't a tool for the average person, but a playground for the rich, and for decades it stayed the way. Until one man dared to challenge. Jack Bogle was not just a financial expert, but a revolutionary. He saw the flaws in the system and asked, why can't everyone have a chance to invest? What if building wealth was not a privilege but a right? In 1976, Bogle introduced the world to the index fund, a revolutionary idea that turned the industry to its head. Instead of trying to be the market, it led the people to own the market. No high fees, no complex strategies, just a simple, affordable way for anyone to build wealth over time. The financial elite mocked him. They called it un-American. They said it would fail, but Bogle wasn't just creating a fund, but was starting a movement, one that prioritized people over profits. But for millions of people, it worked. Bogle's index fund didn't just change how people invested, but their lives. A single idea born out of a vision for fairness gave power back to the people. But revolutions are not easy. Just as Vanguard began to rise, tragedy struck. And what happened next would not test just a company, but the man who dared to change the world. This is the story of Jack Bogle, the man who challenged an empire and gave power back to the people. Jack was born in 1929 into a wealthy family, but a dramatic shift occurred shortly after his birth, when the stock market crashed, leading his father a job loss and struggle with alcoholism. This difficult childhood instilled in Bogle a strong work ethic and determination to succeed. He excelled in school and earned a scholarship to Princeton University in 1947. Upon entering Princeton, Bogle quickly realized the competitive environment was more challenging than he had anticipated. After struggling with his grades, he decided that writing an exceptional thesis would be crucial for his success. He chose to focus on the emerging mutual fund industry, recognizing its potential for growth despite its infancy. This decision marked the first turning point in his life. His thesis garnered attention from Walter Morgan, founder of the Wellington Fund, who hired Bogle as his executive assistant in 1951. Under Morgan's mentorship, Bogle learned the importance of balance in investing. However, as the bull market surged in the 1950s, Wellington's conservative approach began to wane in popularity. In response, Bogle launched the Wellington Equity Fund in 1960, which quickly gained traction. Yet in a dramatic twist, he faced fierce competition during the go-go decade. As investors flocked to higher risk options, Wellington struggled to maintain its appeal, leading to Bogle's pivotal decision to seek a merger with the aggressive iVest Fund. After extensive negotiation, the merger was finalized in 1969, positioning Wellington to reclaim its market share. However, just weeks before he was set to be named as the CEO of the newly formed company, Bogle suffered a massive heart attack. This shocking turn of events left Bogle and the company on the brink of collapse. During his 6-week hospital stay, Bogle had faced a harrowing internal battle, grappling with his mortality and the possibility of losing everything he had worked for. Determined to prove his resilience, he underwent a treadmill test that had astounded the directors. Lasting over 18 minutes instead of the expected 8, this movement solidified his position as CEO. But the battle for Wellington was far from over. In the following years, the merger between Wellington and iVest initially seemed to flourish, with the Wellington expanding to 10 mutual funds and amassing over $2.6 billion in assets. Yet, Bogle remained unaware that his success was deceptive. The speculative growth era was nearing to its end. Yet, by 1974, Wellington asset plummeted from $3 billion to $1.3 billion, signaling the merger failure. Tensions escalated within the company, especially among the Ivers partners, who feared Bogle might hold them responsible for the downturn. In a dramatic twist, they secretly conspired to have him removed, leveraging their voting power. When Bogle was summoned by the board in 1976, he was informed that he needed to resign. This pivotal confrontation became a defining moment for Bogle, who felt betrayed. Rather than backing down, he threatened to initiate a proxy fight, sending shockwaves through the boardroom. The standoff culminated into a compromise. Bogle would remain as president, but with significantly limited influence. It ignited a fire within him to reclaim his vision. Despite being relegated to a largely symbolic role, Bogle refused to accept defeat. He sought ways to come back. During the turbulent 1970s, marked by high inflation and economic instability, legally barred from making investment decisions, he found a loophole in the administrative matters. Recognizing that mutual funds operated like shell companies, he halted the outsourcing of administrative functions, laying the groundwork for significant changes. Bogle's bold internalization of administrative functions at Vanguard marked a significant departure from the industry norms, ultimately saving millions in fees. He boldly renamed the fund from Wellington to Vanguard in 1974, emphasizing a commitment to shareholders' interest through what he termed mutualization. This was a daring move that could either lead to its redemption or ruin. Bogle envisioned a mutual fund run for the benefit of its shareholders rather than the managers. As Vanguard became known for its low-cost investment options, in 1976, Bogle launched the first index investment trust, designed to maximize the long-term profits for its shareholders. Initially, however, it struggled to gain traction, earning the derisive nickname Bogle's Folly. Critics argued that investing in every company was anti-capitalist, and many remained skeptical about the potential of the index fund to yield satisfactory results. Bogle faced a critical moment: to give in to the pressure or to remain steadfast in his vision. Believing the only way to demonstrate the value of his fund was to build a strong track record, Bogle persisted. By 1982, just 7 years after its launch, American investors began to recognize the advantages of index fund, leading Vanguard's index fund to accumulate $100 million in assets. The growing awareness of the cost-effectiveness of index funds contrasted sharply with the high fees of actively managed funds. By 1988, Bogle achieved a remarkable milestone. The first index fund surpassed $1 billion in assets, establishing Vanguard as the second largest mutual fund company in the industry. However, his ambitions remained unfulfilled. He aimed for the top position, currently held by Fidelity, led by competitive Ned Johnson. Fidelity had dominated the mutual fund landscape since its founding in 1930, leveraging a diversified investment strategy and aggressive marketing tactics. The company's flagship Magellan Fund, under the management of Peter Lynch, delivered extraordinary returns, solidifying Fidelity's reputation. As Bogle's index fund began to erode Fidelity's market share, Johnson felt compelled to enhance performance. In a thrilling twist, he instructed his team to pursue aggressive strategies that could outperform Vanguard's offering. But Bogle, however, anticipated that over time, most actively managed funds would regress to average performance. His prediction came to fruition when higher US interest rates negatively impacted Fidelity's emerging market bond funds, resulting in significant losses. As Fidelity faltered and reliability of Vanguard's index fund became even clearer, further solidifying Bogle's legacy. By 1995, Vanguard had reshaped the financial landscape, prompting competitors to adapt. With the company thriving, Bogle decided it was a time to retire. Having groomed his executive assistant Jack Bogle to succeed him in May 1995, he officially passed the CEO title to Bogle while retaining his role as chairman. Bogle, coming from a banking background, aimed to expand Vanguard's assets through increased marketing and sales effort. However, he faced a major obstacle: Bogle's resilience to commercialization of the fund industry. In a dramatic clash, Bogle realized that to pursue his ambitions without interference, he would need for Bogle's resignation as chairman.
Second rule is time is your friend, impulse is your enemy. What do you really mean by time is your friend?
Well, we have the miracle of compound interest working for us. And when you invest over 20 years, 30 years, 40 years, 50 years. For today's young people, an investment lifetime is probably 70 years. Their life expectancy today is, if you're 20, it's probably 90. So you're going to be, and then you're going to be investing, after you retire, of course, and presumably that's in your 60s or 70s for some people. And
not you,
but not me. But that curve is just a sweeping curve, and it's the miracle of compounding returns, and it pays off hugely. Albert Einstein called compound interest the greatest financial miracle of all time, or something like that. So take advantage of that, and the only thing that gets you out of it, focus on the long term. Time is your friend, but if you get distracted by the ups and downs, mostly by the downs, people respond much more nervously to downs than they do ebulliently to the ups, although that happens too. But impulse is going to get you in and out of the markets. But think about this, when the market is low, it's low because people like you are really worried. And that's a good time to buy stocks, essentially. There aren't any rules for this. And if you're ebullient and feel very wealthy and want to buy stocks, that's at the high. In other words, if you're discouraged and selling at the low and aggressive in buying at the high, your money isn't going to last very long.
And I guess that's one of the problems, that you have to try to resist the impulse, because we are human, but we're also animals, and we are basically bred to run from fear. So when we see the market goes low, we want to get out, but we have to resist that. Is that correct?
Yes, correct. And if we just didn't pay any attention to these silly swings in the market, which are, I often use this quote from Shakespeare, like a tale told by an idiot, full of sound and fury, signifying nothing. That's what we're glued to our television sets to watch every day. Makes no sense.